Okay, very good morning to everyone. Thursday the 14th of September. Very significant day in the calendar, the 14th of September, because it is the one and only Vasily's birthday. Can we get a big happy birthday?
Happy birthday.
That guy right there. Come on, Vas, turn around, give us a wave for the camera, please. Here he is. 30 years old. Yep, it all goes downhill from here. Right, let's get down to business. So, first of all, just taking a look at things this morning, just while I'm, before I get underway and kind of what's happened overnight and so on and so forth. Just seeing a bit of upside go through in both major currency pairs. Looks to be more dollar-led, if anything. Keeping in mind we've seen a pretty decent rise in the dollar in yesterday's session. And so, well, hold on 1 second. Just been told I need to reshare my screen, so bear with me. Okay, so looking at the dollar, yesterday very strong gains on the back of a catalyst being some of the commentary about the US corporate tax deal. A bit caught by surprise about the timelines that were issued. Let me just recap the situation for you, because it did help some of the market direction in the US session, certainly helped give equities just a little bit of a lift. Did weigh partly on gold as well as the dollar kind of strengthened. And so what's the deal? Well, the director of the US Office of Management and Business said the target release date for the framework of tax plans will be September the 25th. Now, I think most people are of the belief that any kind of more detail on this tax plan is going to be way further in the future, implementation being way after that. So hearing dates of this month, in fact, kind of 12 days if you like, was incredibly near-term timeline, and actually this obviously causes a more positive response for the market, because it's these types of more policy-sensitive issues that the whole Trump trade was built on in the first place. And although Trump's lost quite a bit of momentum, you would say, on things like the inability on the repeal of Obamacare and how long that's taken, actually the debt ceiling issue has kind of gone away, at least short term. Sorry, Safe? Okay, let me just reshare. I'm having a few issues with my shared link. So we had the debt ceiling issue, that's kind of gone away. And actually I think if it wasn't for the hurricane and the debt relief that was necessary to help the victims of that kind of natural disaster, Hurricane Harvey, and now with Hurricane Irma, then probably we'd still be talking about the debt ceiling. But given the fact that they were kind of wrapping the two issues in together, that debt or crisis relief, if you like, in terms of funding to the debt ceiling, that's kind of passed. So that hasn't been such an issue. And then talk of a corporate tax deal being very quick, then certainly this would be a net positive short term for financial markets. Now, certainly what we saw yesterday with the dollar, and obviously cable had a pretty significant down day, given the fact that you had kind of a dual force, not just dollar strength on the other side of the trade. You had sterling weakness on the back of the wage data was particularly weak. So irrespective of the fact that the unemployment rate in the UK is, I think it's the lowest since 1976. That's been the case for a long time. Unemployment's not the issue in the UK. What is wages, and obviously that missed expectations. Markets giving great influence to that figure for the policy decisions that we're going to be looking out for from the Bank of England later. But we'll talk about that more shortly. So this morning then, maybe just a little bit of profit taking in those dollar longs, and so both pairs just edging up slightly. Euro dollar just looking to come back up towards the 119 handle here. Pivot or cable still remains sub pivot by about 20-25 pips or so. The corporate tax issue though is an interesting one, because what is it that Trump's saying is quite different to what is it that the others, like Paul Ryan, the House Speaker, and the Treasury Secretary Mnuchin have been saying. This was Trump last night. Not sure if you caught his tweet. He said China has a business tax rate of 15%. We should do everything possible to match them in order to win with our economy, jobs and wages. That was the tweet that he said. So the president's always been pretty steadfast that he wants 15%. You know, this is a dramatic slashing of the current kind of benchmark tax rate, or the corporate tax rate in the US, which of course is 35%. You stick on top regional taxes as well, you know, it starts knocking on the door of 40%. So 15% is an extremely ambitious, most people would think. And I'd say market expectations are, it's unsurprising that Trump's making this type of commentary. What's more important is, as I said, the Treasury Secretary, Paul Ryan, they'd be more indicating a potential compromise around the circa 20% level, which is probably, if these details are to be forthcoming towards the end of the month, something of which I'd be looking out for. That's the kind of realm of expectation. The expectation of the broader market isn't 15%. I don't think anyone really thinks that's plausible to be implemented, because he certainly wouldn't get it passed through Congress, I would think. Okay, a few other things then to have a look at. North Korea, no new missiles fired at this point, but there continues to be some reports of movement north of the border, which still warrants, I guess, a degree of vigilance. Actually, just as I speak, I've just seen a Reuters headline come down. North Korea threatens to reduce the USA to ashes and darkness. Yeah, nice way to start your Thursday morning. They've also said here, this was last night, they said North Korea threatens to use a nuclear weapon to sink Japan. So the rhetoric has gone up, it's intensified in the wake of this UN sanctioning that was put in place at the weekend. But at this point, they haven't actually done anything, let's say, physical. No more nuclear tests, no more missile launches as yet. But I would think it would be unsurprising, at least, to see another missile test in the coming days. The question mark, of course, is last time they fired a missile, it flew over significantly for the first time in several years the territory of Japan. And the fact that now they're talking that they want to use a nuclear weapon to sink Japan, and that Japan no longer needs to exist near us, I'm sure the market's going to be potentially quite reactive if there is another missile launch. Now, this could be a very fast, fleeting move in the market, because you'll know pretty quickly what is the kind of trajectory of that missile and where exactly is it heading. If it's heading anywhere over Japanese territory and landfall, if you like, then certainly you'll get a bout of risk-off trade across the board, I'm sure of it. But just depending on where it lands then would be where it goes thereafter in terms of market movement. So still to be watched. It's certainly, the market still is fairly comfortable with the situation. I mean, looking at these charts this morning, you would think that these comments, this situation, doesn't even exist, because here we are, just a whisker away from all-time record highs that we've printed 2 times already. I think Philippe told me the stat yesterday that he heard something like 32, 33 odd record highs we've printed for this year in US equities, which is the highest since many years. And so we continue to kind of brush aside a lot of these things, but obviously from a policy perspective, if these external headwinds continue to remain prevalent, then it does make life very difficult if you're a central bank like the Federal Reserve, and not only are you dealing with the domestic issue of fairly lackluster inflationary conditions, you've also got geopolitical risk on the table, which needs to be factored in, hence the reason why the December hike still isn't priced in. Okay, a few other things though from a market moving perspective to have a look at. I've just had a look at the Swissy this morning, the Swiss franc, you can see here. Now, certainly no defined direction, just some really whipsaw price action upon about 15 minutes ago. You can see here no real trade there on an immediate move, you'd say. Maybe the short on pivot, but a lot of noise coming out because when the Swiss National Bank released their interest rate decision, as expected, no change on rates. However, they always release their accompanying commentary of monetary policy alongside this, and they basically said the Swissy remains highly valued. They will remain active in the FX market if necessary. This kind of intervention terminology that they're utilizing is not unusual. This is very much their regular kind of practice, and so yeah, very difficult trade on there. Probably nothing that would have been quite clear cut. Looking elsewhere though, one other chart in the FX market to bring across is the Aussie, because that did certainly see some movement last night. You can see here big jump appreciation of the Australian dollar, and then we're settling here just above pivot, which is on the psychological 80 kind of mark. Now, why did this happen? Well, the jobs data, if you guys are ever going to trade overnight, the Australian jobs data always moves the market. It's an incredibly volatile piece of data, and so it's very hard, I think, for the market to really get a sense of preparation, market expectation, kind of positioning itself. You know, for instance, if you think about the consensus estimate for the core CPI reading from the US today, we already kind of know if that comes in at a certain level, then it's going to put us down on a year-on-year perspective, the lowest levels we've been in quite a long period of time. So it's kind of built in, the market can position itself accordingly. The problem is with Australian data, it fluctuates so wildly, it can create very large moves in the market, and you get quite often outliers against expectations. So this is what we're looking at here. Australia employment surges in August, led by full-time roles. Check this out. The employment rate rose 54,200 from July. Economists' forecast was for 20,000. So it's more than double forecast in terms of the employment situation. The jobless rate held at 5.6%. That was as expected. There was an interesting quote here that I saw. The Commonwealth Bank of Australia, so one of the main banks, said that over the last 6 months, over 250,000 jobs have been created. So this is specifically Australia. And for a 6-month period, you have to go back 17 years to find a stronger result. So clearly, the economy is gathering momentum. I think that's quite a good summary of a statistic to put their employment situation into some context. It's essentially the run that they've had in recent months is the best it's had in nearly 2 decades. And so sharp move higher in the Australian dollar. You can see here, broke above pivot overnight, and that previous low that was seen back on the 12th, so 2 days ago. Now, it has pulled back slightly because what you have had overnight as well is Chinese data. And as you know, Australian economy, given its high dependence on trade partnerships with China, tends to be influenced, the currency here, by the prospects of how well or how bad the Chinese economy is performing can read across into the currency. And you can see the Aussie, after that spike on the jobs data, did weaken through the rest of the Asian session. But we did have some Chinese data. Retail sales, investment growth, slower in August. So their industrial production and retail sales both missed expectations. So you can see here quite distinct drop-offs that we've had over the last kind of cumulative 2 months or so since we peaked really up in June. Keeping in mind though, is this going to create a kind of new risk off on the back of concerns on China? I doubt it, because ultimately these data points are still tracking at fairly high levels. You know, if you're looking at retail sales, for example, we are still growing. That's growing 10.1% per year on year. And so it's not exactly getting to a point where I think people are going to panic by any means. In terms of the Shanghai Composite and the Hang Seng, so your kind of more Chinese related indices, a little bit of underperformance on the back of that. But again, not really had much of an implication for a read across though into the global financial markets, i.e. the kind of broader context that we're looking at this morning. Another headline that's kind of getting you up to speed of what the latest situation is on Brexit. This came out last night. Theresa May, she's picked Florence for her key speech to win EU support for her Brexit view. So this is, Prime Minister will offer an update on negotiations on the September 22nd. So she's making a speech in Florence. Now this is quite interesting, I guess, from a tactical point of view, choosing Florence, which is kind of a historical trading hub of relationships between Great Britain and Europe that dates back hundreds of years. So I can see what she's trying to do here to try and to appease the kind of European sentiment. I guess the fine line she's walking here is that given the last phase of Brexit talks finished very abruptly without really any progression, she needs to kind of get Europe on side, hence delivering the speech within the kind of historical city of Europe. But she's also got to balance this against the fact that she has the October 1st to the 4th Conservative Party conference shortly after, of which obviously if she panders to Europe too much, this is going to be the opposite of the mandate in which she ran only a few months ago in the June general election. And so the more hard Brexiteers of the Conservative Party certainly would not be happy if she gives too much concession. So quite a difficult line, I feel, for May to walk. But what I would say, from what I've observed of Theresa May, I think that when something happens unexpectedly, how she deals with that and how she responds isn't very good. However, when she has time to plan, she seems like quite a methodical kind of character. She will prepare thoroughly. And when she delivers these pre-planned speeches, actually the market has responded quite positively in terms of the pound. You know, I remember when she delivered that 12 principles of Brexit, and that really was one of the best up days we've had in the pound in a long time. And so I reckon that she's going to come through this speech probably on the right side, because she's got plenty of time to plan it. What she's not good at is obviously talking on her feet, if you like. And so it should be interesting. But as a timeline, September 22nd, that key speech. And obviously a few days after this, you get the Labour Party conference, then the Conservative one to follow at the beginning of October. So kind of defining the Brexit situation. Okay, down to business then. Main events that are forthcoming in today's session. And really there's two things that I want to talk about. That's the Bank of England and also US CPI data that we'll get later this afternoon at 1:30. So starting off with the Bank of England. And this has been quite interesting because we've kind of gone through a bit of a shift of market thinking around this event today. Because at the beginning of the week, on Tuesday, we had UK CPI. And as you know, that went back up. It went from 2.6 to 2.9%, the highest then matching from May, which you'd have to go back is the highest since the summer of 2013. The core reading now up to levels not seen since December 2011. So this reignition, if you like, of inflationary fears, certainly validating the arguments of the more hawkish members of the MPC. So Ian McCafferty and Michael Saunders. The question being then, instead of looking for a traditional 7-2 vote split, are we going to get something like a 6-3, which obviously starts to become much more hawkish. And this is really what the market's been looking at and trying to decipher from the information that we've had so far this week. And following the CPI data, this is a look at the market's pricing towards a Bank of England interest rate hike. And so what we're looking at here is the orange line, or the orange bar, is the September 8th pricing of a hike, and then where we were as of yesterday. And as you can see, in the last couple of days, with this armed now with the latest data that we have, you can see that expectations have jumped higher, i.e. the prospect of an interest rate hike has increased. So if you look at what was priced, if we take 50% as a priced in value, then you're looking at really a hike now priced in at the moment on overnight index swaps February of 2018, whereas before, at the beginning of the week, pre the inflation data, a interest rate hike wasn't expected till really May of 2018. So if you like, we brought forward by a couple of months the prospect of when the next rate hike will occur because of the rising inflation that we've seen. Now, the key point here, and this is what this article that I sent out to you guys from Bloomberg this morning, the risks of a third dissenter joining last month's 2 votes for a hike in the 9-member MPC are growing. So this is what the banks are looking at today, and this is how the market will react accordingly. And so ING going as far as saying a 6-3 vote split could drive the odds of a November rate rise to 50-50. Now, does anyone know why November is particularly significant for the Bank of England? Anyone in the chat? Why November? What does that have of significance that the other calendar months of the Bank of England does not have? Yeah, Sam North, quarterly inflation report. And historically, the Bank of England, much like the Fed, like to, if they're going to make a policy change, do it around the timing of a QIR. Because what it offers them is the ability then to supplement that change with forward-looking view over the 2-year horizon for things like GDP and inflation, and also it's followed with the full and thorough press conference with Mark Carney and his senior MPC officials, where they also have a Q&A. So then he can relay any uncertainty that the markets might have via the kind of Q&A format, much like Janet Yellen does on that kind of periodic basis. And so hence the reason why they're looking at that November in particular, some of these analysts. So, what's the deal then? What's the deal breaker of what we're looking at? And so one thing to understand is, I think I saw it here, 59 economists have been surveyed by Bloomberg for the Bank of England interest rate decision today. Now let's get something straight. All 59 are not expecting any change in interest rates. The Bank of England are not going to change interest rates today. I can say that with pretty much 99.99% certainty. The key here, and the first tradable event, will be on what is the vote split. And really, it's 2 options that you've got. One is kind of neutral, if you like, and one is hawkish. And that is either 7-2 or 6-3. If it is 6-3, the name of which most people think you should be looking out for is Andy Haldane. He's the chief economist of the Bank of England, because he has given some speeches of late which have contrasted with that of the governor Mark Carney, of where even Carney himself has changed a little bit, but Carney tends to kind of be fairly neutral. But Haldane has been quite hawkish in recent weeks, and most people foresee that if there is someone to join that hawkish contingent, then it's going to be Andy Haldane. So they're the 3 names you're looking out for: him, McCafferty and Saunders. If that happens, you would expect probably initial knee-jerk reaction higher in sterling currency. The question though is, what is the accompanying commentary that comes out? Because as you know, with the Bank of England, it's not just the interest rate announcement, the asset purchase facility, both expected to be unchanged, and the vote split. We also get the minutes. Now the minutes can be a little bit more difficult to trade, because you need to assess what is it exactly is the general tone of which the overall summary of the minutes are giving you. Now, sure, if there's an outright significant comment that says something like the majority of MPC are growing more concerned about rising inflation and an interest rate tightening move is on the horizon, something like a statement like that, one line, would be incredibly hawkish. And then after you get this 6-3 pop, there might be an opportunity there to get long the market again for an extension of the move. However, obviously, as we know, the Bank of England are tackling a very difficult situation, and this was exactly epitomized by the data that we've seen in the last 48 hours. One is your inflation, which is here that we've seen, and the other, that being lagging average weekly earnings. And so that whole prospect remains the same, where wages are not rising, and this real negative wage situation in the UK, which is kind of tightening the screws on the UK consumer, and obviously comes in the context of fragile sentiment amid political uncertainty, both home and abroad, with negotiating Brexit and the fate of the Conservative leadership, means that this situation is what then is the balance, and where do these MPC members want to place what they feel is more important? Is it that of inflation, or is it that of the more negative setup of the ramification of the lack of confidence, lower household incomes, so on and so forth? And this is what we're looking out for in details of the minutes. What I would say is that I kind of see it potentially, if we get a 7-2 as expected vote, what I'd be looking for in the minutes is possibly a material change towards sounding slightly more hawkish because of this move back higher that we've had, particularly in core inflation being its highest in about 6 years. So I am looking for a slightly more hawkish tone overall in the minutes. And so on the balance, the risk then would be for slight upside in sterling currency, because you either get a 6-3 vote, which would be hawkish, the pound rallies, or you get 7-2, but the communication in the minutes is enough to be overall deemed to be moving slightly more hawkish in that respect. I think what the Bank of England will want to do with these minutes today, and with the discussion that they know will go public to the market, is they'll want to have credibility that if necessary they can raise interest rates. That doesn't mean that they'll do that, but what it means is that the market remains respectful of the fact that they can do that, and that's what their ultimate goal is, to kind of use this verbal tactic to address market expectations. So we'll talk about this more, obviously, when we get closer to the time, as we get to midday. Looking at the calendar, so for this morning then, really there's nothing now until we get the Bank of England event. That's happening, of course, at midday. Then you get the US CPI data, and that's coming out at 1:30. Now this is interesting, because of all the data, this is probably the one of which the market is assigning the highest priority to in order to ascertain the probability of the Fed hiking interest rates and tightening policy in the period into year end. Now it's grown almost more interesting because yesterday we had a miss in the PPI data, and what I'm looking at here is the US core inflation rate. Now Deutsche Bank made a couple of interesting points here this morning in their note. They said we've had 5 consecutive downside misses on the core US inflation reading. As you can see here, we've been down at 1.7%. Even an inline reading month on month in core inflation today from the US would result in the year-on-year rate slipping 0.1 to 1.6%. Now let me just put that into a bit of context. If we go down to 1.6%, it means it will be the lowest since January of 2014. Anything below there, even if you got to 1.5, then you're looking at the lowest since really going back to 2010, 2011. You know, if you're talking about inflation when it was first gone down to 1.7, this is when Janet Yellen started making comments, and the rest of the FOMC, that there's uncertainty about the prospect of inflation. That was the kind of thing that's holding them back from being overtly hawkish. So if we get another drop-off, it's going to be interesting to see how this changes the market's feeling towards the ability for the Fed to be able to take action later this year. Of which, let's just have a quick look at what the market is pricing. Yesterday, I did notice actually it crept back up to about 40%. Let's have a look at the odds in the federal funds rate futures on the CME for December rate hike. We are looking at 46%. Actually, it has risen. That doesn't really surprise me too much, because yesterday there was a bit of a knee-jerk reaction to this quite positive timeline of the implementation, at least, of more details coming forward on the corporate tax plan. So yields did rise, the dollar appreciated quite sharply yesterday afternoon, so the prospect of the hike now is up to 46%. If you think about it, after we had that pretty abysmal payrolls, it dropped to about 30%. So since that Friday on the 1st of September, it's gone from 30 to 46% now. But certainly this inflation data today, let's say, what if we get an upside surprise? That then tips the balance, will go over 50% likely, and then it's all good to go in terms of how the Fed will be monitoring the situation. Other than that though, other than the CPI numbers, they're totally going to outweigh the jobless claims. That's nothing to really worry about. Again, much like the UK situation, these metrics have been fairly healthy. It's really the inflation issue which hasn't been so much so, and what the Fed and the market consequently will be focused on. Speakers, there are a couple to be aware of, and there's one particular chap which sticks out, and that is Jens Weidmann of Germany, the Bundesbank. He is speaking at 4:30. Now, Weidmann's got quite interesting of late. Vas was talking to me earlier this week about it. He was talking about the way in which Weidmann has started to tone down some of his hawkish rhetoric. We know that he's a representative of Germany. He is the outlying hawkish member of the ECB. But there was even reports in, I think it was El Mundo earlier this week, a European newspaper, suggesting that Weidmann is positioning himself to hopefully take over from Draghi when his term finishes. And so he started to become less of an outlier, trying to be still hawkish, but a little bit kind of so distancing himself from the rest of the pack. So kind of more centre-right, if you like, rather than far-right, so to speak. Not saying that's his political view, but putting it in that kind of context. So what Weidmann has to say, I think, will be very interesting. Influential member, and also Yves Mersch as well, chairing a panel, speaking at 2 points today, 11:45 and then 5 o'clock. These will be important. Okay, that's it. So I'm going to leave it at that. I'm going to wish you a good trading day. If you want to talk about any of the technicals and so on, sure, Philippe can help, and I'll be in the chat room throughout the day. Okay, guys, thank you very much.